Hello, and welcome to my presentation on the 4-bucket strategy. I'm Ted Carr. Thank you very much for joining me for my presentation. Let's start out by looking at what we're going to cover today. This is actually an update to a presentation I did back in March of 2019. In that video, I covered what I'll call the standard 3-bucket strategy. And today, I wanted to do something that's actually part one of a 2-part series that I'm working on. So I want to update the bucket strategy to be part one. What will follow will be part two, which will be on how to manage buckets. And it's actually kind of a more challenging, more difficult presentation to put together. Now, I want to point out that the content that I'm going to cover is illustrative only. It's not a recommendation or endorsement. I'm not a financial professional, and I encourage you to do your own research, including consulting with your financial professional if the bucket strategy is something that you want to pursue further. Now, I want to make a couple of announcements before we get into things. First, I'm charting a new direction for my podcast. I'm going to change up the formats, and the format change is going to be, it's just going to be me and my wife, Claire, doing a conversational podcast. And of course, that means that the hosts have changed. Roy is no longer be one of my co-hosts. He'll probably take on an announcer's role, but that's down the road. And the focus. Now, we're going to go all in on what we call later to fire, financial independence, retire early. Instead of being part of the huge financial independence podcast community, we're going to try to find a niche that's maybe underserved and underrepresented. So I'm really excited that starting in June, that'll be sort of our proof of concept podcast for the new direction we're heading in. And since change is the name of the game here, I've also made a change to my writing style because, to tell you the truth, writing is, for me, mission impossible. Writing lengthy articles, it takes me 1 month to write sort of a full feature article. So what I'm doing is I'm writing in much shorter bursts, kind of like a short story. And I'm actually having fun. I'm actually enjoying it. My first such article is called Planning Parasites, and it's a lot of fun. You can find it on my homepage at firewalkers.co, where you can find all my content and various links to different types of material that I produce. Okay, enough shameless self-promotion. Let's go over the agenda for the presentation. So we're going to briefly review what a bucket strategy is. I'm going to go through the highlights of the standard 3-bucket model. And then the 4-bucket model that I use, we're going to go in more depth on that. And I'm going to present an example, and of course, one of my favorite formats, which is an Excel spreadsheet. We'll look at the benefits of the bucket strategy, some of the challenges that we face if we use a bucket strategy before we wrap up. So here we go. So here's what a bucket strategy is all about. It's basically a method of classifying and managing investments. A bucket is nothing more than a logical or virtual grouping of similar investments. And buckets contain investments grouped by time and risk, and I'll explain that as we go along. And buckets are a way to manage systematic withdrawals. Use cash and short-term liquid investments for current living expenses. Now, there are guidelines to establish sound practices. They're not a recipe, they're not cast in stone, they're guidelines. Big difference. So reviewing the 3-bucket approach, which again, I went into great depth in March 2019's presentation. Bucket 1 is money you need now. And bucket 2 is money you need soon. And bucket 3 is money you need later. And in my presentation, I go into provide a lot of examples of what types of investments go into each of those 3 buckets. So I just want to do that review before we get into the 4-bucket approach. And this is the approach that I follow and my wife follows too. And in bucket 1, it holds cash and cash equivalents. Bucket 2 holds bonds and bond funds. Bucket 3, balance funds and derivatives. And bucket 4 is where we logically or virtually group our equities. And let's take a look at an example. Okay, so here's my example of a 4-bucket strategy approach. And start out by pointing out that one of the key pieces of information that's very useful and important to have is what your annual budgeted expenses are. And in this example, and it's all just made up data, just to illustrative purposes to make these points, I'm saying your annual budgeted expenses are $50,000 per year. And here you'll see the 4 buckets, bucket 1, 2, 3, and 4. And I have them set up this way. And this is how I keep track of things. Just you don't have to do it this way, but again, I'm just showing the way I do these things. So in bucket 1, we have cash and cash equivalents. And cash equivalents are things like, you could say a CD that's maybe a 12 or 18 month CD, money market funds, things of that nature that, are very, very liquid. Bucket 2, and this maybe is unique to me, maybe where I diverge a little bit from the 3 bucket approach, is where I, again, virtually, logically, I keep track of my bonds and bond funds. Bucket 3 is where I keep track of what we call balance or hybrid funds and derivative funds. And I'll explain a little bit more about those in a minute. And in bucket 4 are equities. And if you were to draw an arrow in terms of risk, it goes from least risky, slightly more risky to most risky. So that's just to give you an idea of the risk relationship of the 4 buckets. Now, I also like to track how much I have in each bucket according to whether it's in a taxable account, i.e. a brokerage account, or whether it's something that I've got in a tax deferred account, like a 401k or an IRA, for example. I just like to do that just because you want to make sure that you've got enough money in taxable buckets to keep funding your buckets as you need to refill them. And again, I'm going to get into that in my second presentation. So what I do, I'll keep track of my subtotals for taxable and deferred for each of the 4 buckets. And I will summarize how much is in each bucket. Now, what's great is that you can take the amount in each bucket, divide it by the total that you have in all of your buckets combined, and voila, that gives you your asset allocation percentages, which I think is very helpful. And again, I didn't put a lot of thought into what the percentages should be. I think, again, it's just pointing out that if you do go to this level of effort, it is a great way to keep track of your asset allocations. And just like the bucket strategy is a guideline, I think of asset allocations, again, as guidelines. You're probably always going to be a little bit off of what your targets are, but that's okay. It's just staying within 5 or 10%, depending on your sensitivity, of what your targets are for each of your buckets in terms of asset allocation. And now the time dimension, and this is where that $50,000 annual budget expenses comes into play, is that here I've got 2 years saved in my first bucket, and this is my most liquid. This could be helpful as an emergency fund or by living expenses, basically. So I've got 2 years of living expenses, and I think that's reasonable, especially with the types of uncertainty we're all facing in the present tense as I go through this presentation. And in bucket 2, we have 3 years. And in bucket 3, we have 3 years. And in bucket 4, that's going to vary depending on how much money you put out into bucket 4, your asset allocation, and of course, how much you have available in your investment portfolio. But I think the point I want to make is this bucket's really important, and I think you should have a minimum of at least 1 year. I would go for even more than that, go for 2 or more years for bucket 1. But I digress. So in bucket 1, this is the Vanguard Money Market Fund. And again, I have other things in my bucket 1 cash equivalents, but I won't get into those. That's not what this is about. I keep track. This is in my taxable brokerage account. And a bucket 2, this is a Bank of America note. It matures in 2 years, which puts it into this bucket. And this next one is the Government Intermediate Bond Fund. I can't remember if it's an iShares or not, but those are treasury notes that have between 1 and 10 years in duration, and that's how they define intermediate. I'd rather have it be on the shorter end of the duration, since this is a 3 years worth of investments. I'd rather try to align my my maturity dates with with that bucket 3 years worth of money. But intermediate I think is a good enough kind of concept to put things in here. And again, this is just for illustration purposes. Bucket 3 is where we have our balance and derivative funds. That's a Fidelity Balance Fund, which again is made up of some bonds, equities, and some other types of investments. CWB is a convertible bond ETF, and that's a hybrid kind of an investment vehicle, a convertible bond. And so I called it a derivative, and so I put it here, and you can put other kind of derivatives in here, maybe REITs, for example, things of that nature. And out here in bucket 4, that's a Dow 30, the S&P 500, the NASDAQ, and the Russell 2000. And again, I'm just showing that you shouldn't have all your money in just taxable or deferred. You want to be able to move money from bucket to bucket, so you make sure that you've got enough money to keep your first bucket, the one that's most liquid, the one that you actually are going to be consuming. You want to make sure that you've got enough money over the course of your working career that you don't find yourself in a shortfall. Anyhow, I will get more and more into how you manage these buckets in my second presentation. But for now, I just wanted to briefly show you how I set up my buckets, the risk relationship, my interpretation of time, i.e. how much money, how many years worth of investments you have in each bucket. And what I think is a really great feature is the ability to use it to help keep track of your asset allocations. So let's move on to our next slide. So let's review the benefits of implementing and using a bucket strategy. Now, one of the big ones, at least from my perspective, is what I call psychological advantages. And buckets, they reduce anxiety during times of market volatility, including like the sell-off that we've been experiencing through the COVID-19 pandemic crisis, crashes and corrections. So, it's only natural for us investors to feel a lot of stress when the market is very unpredictable, which it is now. And kind of the way the psychology works is that in bucket 4, where you've got your most volatile, most risky assets, the ones with the higher beta, those losses kind of happen in the future. You can just sort of mentally envision that money you don't need for, say 10 years out, there's plenty of time for those losses that are happening on paper to correct and get everything back on track again. So for me, it gives me a lot of peace of mind knowing that whatever volatility is affecting my portfolio, it's affecting that bucket that's earmarked for well down the road. Now, another benefit of the bucket strategy is that it mitigates the risk of behavioral biases that lead to bad decisions. And those two are kind of related because we, as investors, are kind of our own worst enemy. And we have a lot of biases following the herd, where we just sort of panic sell. And I think with the bucket, if you can get that psychology, that advantage into your mind, then it's going to help you avoid selling when the market is low. So the bucket strategy, I think, again, from that psychological standpoint, sets up guardrails, and it keeps you from, following your instincts and following what everybody else is doing, which can lead to some pretty bad outcomes. Another benefit is it's easier to understand than standard withdrawal rate strategy. It's very intuitive. It's not hard to understand. If we kind of segued or went off and started talking about the standard withdrawal rate strategy, I think you'd find that it's a little more complicated. It's not as intuitive. Though for the people who manage money, it's actually a lot easier to manage and practice. One of the great things that I like about the bucket strategy is that, as you saw in the example, it combines asset allocation management. And I think that's really great because it's always good to be aware of how your assets are allocated across different investment categories. And that's where risk comes into play, is through your asset allocation. You can have a high risk strategy where it's, back end loaded, say, towards equities, or it could be low risk, where you may be doing more with cash and bonds, that sort of thing. So I think that's a really great window that the bucket strategy allows you to have, is to see your asset allocations. And as long as you keep it updated, you can manage your asset allocation in conjunction with managing your buckets. And another key benefit of the bucket strategy is, again, that psychologically, if you're not afraid of losing money that's earmarked for way out in the future, then it encourages you to take that risk, right? That you can then feel, yes, indeed, I'm comfortable with having equities because equities are essential to ensuring that you don't run out of money during the course of your retirement life. And that's another way of saying it mitigates longevity risk. So I really think there's a lot of really great benefits for at least looking into whether the bucket strategy works for you. Now, of course, we look at the other side of the coin, which there are challenges in doing it this way. One is that there aren't any standards. And I think, just from this presentation, I presented a 3-bucket strategy, and I went into that in March 2019 in depth. And there's a 4-bucket strategy. And if you were to search it on the internet, you'd find sort of different reasons why people are doing bucket strategies. So there's no standard, which is okay, because I think that means it's customizable, it's flexible. Just that guideline and the model itself, I think, is where the value add is. It's something that appeals to me as someone who likes to do things that are more tailored to my individual situation. Again, I mentioned there's limited management tools. See, I love spreadsheets, but there's maybe not an application that I'm aware of, at least, or maybe even your financial professional is aware of, that actually can elegantly, manage your buckets for you. And again, getting into that, the complexity, it's harder to manage than the standard withdrawal rate strategy. But all things aside, you can be the judge as to whether you think the bucket strategy is an approach that you would want to look further into. For me, I'm just sharing, just for illustration purposes, what I do, why I do it, why I like it. And I'm not making a recommendation. I just put it out there, and hopefully it's something that at least spurs some thought. And let's wrap her up. So as I mentioned at the outset, my next presentation is going to cover how to manage the buckets. And I think that's actually a lot more challenging than just going through what the bucket strategy is and what goes into each bucket. How to manage them, I think, for me, has been more challenging to work through. And again, just a reminder that just for some context, find my March 2019 video on the 3-bucket approach. And I think you'll like that, because I think it gives some great perspectives on what type of investments go into these buckets, and what the rationale is for using a bucket strategy approach. Again, just going to remind you that there's some things you can subscribe to. I have a YouTube channel, as hopefully you know, Retire Hobby YouTube channel that I hope you subscribe to. I do a monthly newsletter, and you can subscribe to that from actually my retirehobby.com homepage. And I hope you consider doing that. It's, again, no cost. And I mentioned my Firewalkers podcast, which the new format is going to drop in June. So you can find it on iTunes, on Stitcher, Google Play. Many different platforms actually make my podcast available. And I'd just like to ask you to please consider sharing this video and all my content with your colleagues and friends and family members, people who you may think would find this helpful. And I'd love to hear from you. You're welcome to leave comments either on my YouTube video, this video itself, or on any of the articles I write. Please feel free to share your thoughts. And above all, I want to thank you very much for taking time out of your day to watch my video. I hope you enjoyed it, and I hope you join me for part 2 of my series on the bucket strategy. Thank you, and take care.